Oh, welcome guys to Money Mondays, where we are focused on raising private capital and investing with purpose. So whether you are a new investor or an experienced investor or even a business owner, understanding the art of raising private capital is crucial in today's competitive landscape. Join us as we navigate the complex realm of attracting investors, securing funding, and building meaningful relationships that fuel your business growth.
Hello, everyone.
Hello. My name is Kalisha, and I have my co-host Betsy. And on today's episode, we'll be interviewing an EA, which we'll get deeper into explaining what an EA is, because I know at first we had CPA, but there's a significant difference with that. And our guest today will be guiding us in things to consider when it comes on to tax planning as real estate investors and also as private money lenders. But before we get into it, Betsy, you want to hit them with that disclaimer?
Yes, our disclaimer, everyone. The following information is for educational purposes only. Please do your own due diligence. We do not provide financial, legal, and professional advice.
Yep. So, guys, we are just sharing our experience, and our guests is just giving advice. That's it. Like, without further ado, hey, Joseph, what's up? I feel like it's been a long time that I've seen Joseph, or a long time since we've done the episode.
I know.
Like a week.
Good to see you.
Oh my gosh. Well, thank you everyone for joining in. Like, we appreciate it. We are growing. Thanks to you guys for sharing. And we've been getting some great feedbacks too. Just persons who have been finding each episode so valuable and having questions about it. We're so happy that you guys are, because that's what we want to do, is provide a ton of value to you guys. So you want to jump in?
Yeah, we're just really excited for our episode today that we have a tax expert talking about everything taxes, especially us as business owners. A lot of us like try to focus on one thing, and we're just like, oh, I know this is important, but I don't have time to like look it up, or where do I even start, right? Where do I even start? So I think it's super, super cool and important that she is here with us, and she's going to be answering questions. Yeah.
So let's dive in and welcome Kathy Curlin. She's not a new person to the episode. So welcome again, Kathy, to our channel. We're so happy to have you on again.
Thank you for having me. I really enjoyed it last time, so I really appreciate you having me back today.
No, of course. So let's go right in, because I've never heard about EA before. So could you touch on that a little bit in terms of telling us what's the difference between an EA and a CPA?
So a CPA is a certified public accountant. And so they get an accounting degree from a university. So they are an accountant.
Yeah.
And they take tax classes. You know, a good accountant who wants to do tax will take tax classes. An EA is an enrolled agent who studies tax. And if they want to do accounting, they take accounting classes. An EA is federally licensed. I'm actually licensed by the Department of the Treasury. And a CPA is state licensed. An EA is the only category that's actually federally licensed.
Gotcha.
And we have actually been licensed since the Civil War. We were actually licensed because the people who owned farms back then were trying to cheat the government out of claims for losses during the Civil War.
Gotcha. Okay. See, I learned something new every day, because I did not know that much about an EA and the story behind it. I know, like, a lot of, from our last episode, there were some little things that and tips that you gave us that as real estate investors that we should look out for, and also as private money lenders we should look out for. One of my first question is that this one is specifically on behalf of borrowers, real estate investors who are borrowing money from private money lenders. We tend to borrow capital from private money lenders and pay interest, right? As it relates to interest payments, is there like any form of tax deductible for the borrower just to show that, hey, I paid interest payments during this time?
Absolutely. All the interest that you pay when you borrow money is tax deductible. No problem whatsoever. It's tax deductible. Now it depends on what kind of investing that you're doing. You know, if you're buying a rental property, it'll be tax deductible. If you're flipping a property, keep in mind that when you're flipping a property, that property is going to be considered like inventory. So then you'll write it off when you sell the property, not right away.
Ah, so there's a difference.
Yes.
And how does that affect your taxes, the difference?
You don't want to write off if you're flipping a property, you don't want to write off your expenses until you sell the property, because if you don't sell it the same year, let's say you buy it in December, you don't sell it until January, 1 year you'll have all these expenses with no income. The next year you'll have all this income and no expenses. So it would be too much income 1 year. You know, you don't want to have $300,000 of income and no expenses. You'd pay way out of proportion of income. You'd rather have 300,000 of income and 200 or 50,000 of expenses. It would be way more fair.
Yeah.
It would be fair when you're to have $250,000 of expenses and no income to write off against.
I mean, that makes sense too. Because you also have a lot of borrowers who they may think their project is going to end in December, and it goes over into January, February. So that's actually a good tip. I never thought about that. I would think that all the expenses would come out in that calendar year, and then whatever is left goes over into the following calendar year. So that's a good point.
You would think so. My mother was a title officer, and people would show up at the title company to close escrow on December 31st.
Yeah.
And you can sometimes only get so many titles that actually close on December 31st before midnight. And there's always that possibility that title closed January 1st at 12:01.
No, that makes so much sense. And then from one thing as well, that it's something that has happened to me in the past, and you have brought this up too in the last episode, is that a lot of times we wait until December 31st or the month of December to start getting all our paperwork in order, or we wait until January to reach out to our tax preparer or whoever it is that doing our taxes and ask them, how can we benefit from this or that? You know, so my question really is, what advice would you give to investors rather, to prep for the tax season throughout the entire year instead of waiting until the end of the year or January 1st?
And I think I told you that was like my pet peeve, right?
Yes.
Yeah.
If have your bookkeeping done on a regular basis. Pay a bookkeeper to do it regularly. Yeah. It is more expensive to have bookkeeping done retroactively than it is not to do it properly. Because if I have to come and do a whole year's worth of bookkeeping, now we're talking about almost like an emergency situation for you.
Yeah.
You know, I'm going to charge you a premium for it. If I have to do your bookkeeping in January, I'll be honest, I'm going to charge less than if I have to do your bookkeeping in April. If I have to do your bookkeeping in April, you're going to pay probably 50% more than if I have to do it in January, because taxes are due in April. I got a whole bunch of other clients. You actually may have to go on extension by April. So it's way cheaper. You'll still have it done. Not only that, but how do you know how much money you made? How do you know what your profit is? Most people are not aware that if you owe $1,000 or more at tax time, there's a penalty for owing too much. You're supposed to do estimated quarterly payments. along the year. How do you know if you're supposed to be doing that if you don't have your books done on a regular basis?
Mm-hmm. I know a lot of persons don't even do quarterly taxes. A majority of persons, well, that I know, they do it at the end of the year. What would you say the pros and cons of doing both ways?
Well, the problem is all of a sudden there's this big tax bill. You get a $20,000 tax bill. You don't have $20,000 in the bank. And they go, oh, well, I'll just ask the IRS for an offer and compromise.
Yeah.
They're not going to get it. And you don't have $20,000 to pay that bill.
Mm-hmm.
And they think that some miracle is going to happen. And they don't have, they're going to go on, then they're going to go on in a payment arrangement. They're going to, and then what's going to happen is because they owe this $20,000, now they can't make an estimated payment for the next year because the money they could have used to pay that estimated payment for the next year, they have to use to pay their money for this last year. And now next year, they're going to have another $20,000. So it becomes a cycle, which you can never catch up from. And there's interest that's going to continue building for every year. And every year, you're going to have a new penalty. So it becomes a cycle that you can really never get out of. Unless you have some kind of big year where you just pay it all off. It just becomes a cycle. And the thing is, you don't have to get into that cycle if you had done your bookkeeping right from the beginning.
So what about persons who are doing the profit first method, where they set aside amount for taxes? If they're still doing profit first method, would you recommend that they still do it quarterly?
So you can, if you want to, sure. And if you're doing profit first, that's fine. If you're putting that money, people use the envelope system. If you're actually putting in envelopes, you're not getting any interest on it. That's not any helpful. If you're putting into a bank or an account where you're getting interest on it, if you have multiple accounts or a way to put it in. So people do profit first. They'll put it into a bank with like some sub accounts where they're getting interest on it. That's fine. As long as they have the money when the money is due. But again, same thing happens. If you don't pay the quarterlies, then when tax time comes, you owe it more than $1,000. You're still going to have the penalty for owing more than $1,000. But if you made more, think about it this way. If you make more interest than the penalty, that could be worth it.
Yeah.
I had a client who always owed $20,000, but he could never he needed that $20,000 for cash flow during the year. He knew he was going to owe $20,000. He had the $20,000 to pay it. He said no bank is going to loan him $20,000. And the interest paid to the IRS was cheaper than the bank. So he planned for it. And it was a financial decision he made on a regular basis, and he knew it was going to happen. I don't have a problem with that because it was a well thought out business plan.
Yeah.
So that's something we have to sit down and discuss and make sure that you're well aware and you're going to have the money to pay it.
So last time we spoke a little bit about giving 1099s to your lenders. Can we talk a little bit about that again and how, if you have it structured where you have more than one private money lender on a specific property, does that affect or change things in any way?
So your lenders are going to give you 1099s. If you're paying them interest, the lender is going to give you a 1099 for the interest that you're paying. Every lender that you're giving interest to is going to give you a 1099. You're not going to give them a 1099.
Yeah. So does it matter if you have more than one lender on a property?
Nope, doesn't matter. Any lender that you're giving money to will give you the interest. A bank will only give you a form for interest if you get $10 or more of interest. So you won't hear from the bank.
That makes sense. And then, so even like for borrowers who are listening, if your private money lender doesn't give you a 1099, ask for it. And we should ask for it like months in advance. Well, not even months, because there's a certain time when it comes out. But what if that private money lender doesn't provide a 1099? What steps should that investor or borrower take to get access to that 1099?
I would still write it off whether they send it to me or not.
Mm-hmm.
They should still be sending it, because if they don't send it, they could get fined for not sending it.
Ah.
Yeah, there are fines for not sending 1099s. So, like if I am a hairdresser and I rent a station in a salon and I don't send the salon a 1099 for renting my chair, I can be penalized for not sending that 1099.
Yeah, and that's it. And that is it. That only if it's coming through a savings account or some type of taxable account.
No, if you are legally supposed to issue a 1099 and you do not, there are penalties for not issuing it. That's how the IRS tracks how money is spent and who is getting money. It goes into a computer. The IRS has two computers, one where all the documents go and one where all the tax returns are. And by around summertime, they take the two computers and they run a match, and all the documents need to be on a tax return somewhere. And if there's a missing form from someplace tax return, a letter gets issued out automatically. It says, hey, this form is not on your tax return. Maybe you want to take a second look at that and report it somewhere. That's the first nice letter you get.
Yeah.
And the next letter you get is, you didn't report that letter. Let's rearrange your tax return and send you a bill.
See, that's interesting. So guys, ask for those 1099, and private money lenders, please provide those 1099. I think we should be able to get like, there's like even different websites that you can go on and generate 1099s too. Because a lot of persons, isn't there? What are some of those websites that persons can check out?
I use Track 1099.
Track 1099.
Mm-hmm. That's the one I use all the time. But there are lots of the IRS. I think there's a fire system which you can get registered on to use for free.
Mm-hmm.
If I did tons of 1099s, I would just get on the IRS system. But I like Track 1099 because I can go on there, and if I've been authorized, I can even just have the 1099 emailed for it to you. 1099s actually go to Social Security before they go to the IRS.
Yeah.
And they just handle the whole thing, so I don't have to deal with it.
Yeah. There was this other website that I used too. I can't remember the name. That you can even file those taxes on behalf of the persons. You can, as you said, you can forward it directly to them. And it was like a small fee. You can mail it to them as well if you want. There's a bunch of different websites out there.
Yeah.
One of my next question is, as private money lenders, there's a difference between the interest income and there's a difference between capital gains, because you have private money lenders who they do fix and flip, but they also lend. What would you say are like, what is like the tax rate, or how are they taxed for if it's an interest income, and how are they taxed if it's a capital gains?
So capital gains is taxed at one of three different rates, either 0, 15, or 20%.
Okay.
Biden wants to change that. Biden actually wants to put it up to 37%.
Wow.
Hasn't been successful. So right now it's at 0, 15, or 20. And that depends on how much other income you have.
Mm-hmm.
So for example, if you're single and you have other income, so let's say you make $20,000 as a salary.
Yeah.
The amount for capital gains is up to about 40. So you make 20,000 in income, 40 minus 20 is 20. So you can make $20,000 in capital gains at 0%. So the next step, then you're going to start paying on some capital gains.
Capital gains.
So that's the $20,000 in free income.
Mm-hmm.
I'm married, so $40,000, $80,000 is our limit.
Yeah.
I made $30,000 in W-2 is what I paid myself. My husband has Social Security, which I made the numbers, the thresholds low so that his Social Security wasn't taxed. So 80 minus 30 is 50. I took a $50,000 distribution from my business and took $50,000 in 0% distributions.
See, guys, if this made sense, please leave us comment. If you feel lost, drop a comment as well. If you want Kathy to go over this again, explain the example, drop a comment, because we want to make sure that you guys really understand what we're talking about. Because a lot of times the whole talking taxes can be boring. It could be like your mind feel like it's exploding. But I think it's something that we all should try to understand as well. Because a lot of times with Kathy, when you do like the W-9, when I had a W-2, and you will see on the back of the form, single, just to know a tax bracket, you see single, married, and this and that. And I'm like, this is too confusing. I'm not even going to try to figure that out.
My biggest goal in life is to see how much money we can take out of a business tax-free.
Mm-hmm.
You know,
Yeah.
I was a corporation. I'm a corporation, so I'm not an S corp, and so I want to be able to take as much money as I can out tax-free.
Mm-hmm.
You know, when COVID hit, I was able to give myself an award for designing my COVID relief plan.
Yeah.
If I'd been an S corp, I wouldn't have been able to do that.
Why is that?
Huh?
Why is that? What's the benefit of having a corporation and versus having an S corp?
An S corp is like a hybrid.
Mm-hmm.
And so there's a lot of benefits that if I give myself the benefit, then I have to put it on my W-2. So I pay tax on it. So I can still deduct it from the corporation. I pay tax on it. It's still cheaper to pay tax on it than to pay the whole thing.
Mm-hmm.
But as a C corporation, I don't have to pay tax on it. So I'm deducting the whole thing. So the more things that I can take out as a deduction, the better.
Mm-hmm.
You know, and so yeah, so the more things I can take out, the better. You know, so I looked for those type of things.
So even if you don't have a W-2,
pardon me?
Even if you don't have a W-2, would you still recommend doing a corporation versus an S corp?
You would have to have a W. If you're a corporation or an S corporation, you have to take a W-2. You have to take a fair market wage. With an S corporation, the IRS looks to see if you took enough money, because people don't want to take enough money. With a C corporation, they're looking to make sure you don't take too much.
Mm-hmm.
So there's those balances, and that's another reason you have to work with a tax professional who understands the balance.
Mm-hmm.
With an S corporation, there's two parts. There's a salary and there's a distribution. And some distributions a lot of times come with no federal tax, and they come with no Social Security and Medicare tax. There might be federally taxed, they may not, it depends.
Mm-hmm.
So people want to make that distribution as big as possible.
Yeah.
And the salary as low as possible. But the salary has to be a fair market wage.
Mm-hmm.
Whereas with the C corporation, the IRS says, "Oh, we want your wage to be fair market wage. We don't want it to be too big."
Yeah.
Because they're the dividends, we want you to take dividends, which are double taxed, because you take a dividend and it's not tax deductible to the corporation, but when you put it on your it's taxable to you as a person. Now it's being double taxed. They want you to take the distribution, to take the dividend, but you don't have to take dividends. So corporations are not double taxed if you don't take a dividend.
Yeah.
Mm-hmm.
So you can totally avoid the double taxation if you just don't take a dividend.
Yeah.
So
are there any specific deductions or credits available to private money lenders that can help reduce their tax liability?
Oh, absolutely. And I was even thinking about creative ways to get paid for the private lenders. And it depends on if they're employees or if they're self-employed.
Mhm.
You know, I was kind of thinking because I had a coworker whose husband worked for a private money lender, and he had made this big commission, and his commission was going to be paid over 5 years. So that was kind of nice because it was like $100,000. So now he was only going to have to get paid, $20,000 a year. Well,
Mhm.
tax on $20,000 is a whole lot less than tax on 100,000. So over the year, he was going to pay way less tax.
Yeah.
I thought, well, gosh, can you, if you're an employee, maybe you can negotiate with your employer on when you get paid. Can you get, can you negotiate a payment on a bonus over time?
Mm.
Because bonuses are taxed at a way higher rate. So can you negotiate how you get paid or when you get paid? If you get a bonus in December, can you negotiate a bonus paid over December and January? So you
Mhm.
get it split over 2 months, over 2 years. Are these things that your employer is flexible on?
Yeah.
Or if you're self-employed, if you're a lender, you really don't have a lot of things because most lenders are probably cash basis because you recognize the money when you get it. You don't really have an option to be what we call accrual basis, which is you get the money when you earn it,
Mhm.
and that's really not really an option for a lender. But if you're a C corporation for a lender, well, then you make up your own rules on when you get paid. And you can make up any reasonable rule for how you're going to pay your employees.
Mhm.
And you're an employee, so you can make up any reasonable rule. And a reasonable rule could be, maybe you pay that bonus over a couple of years.
Yeah. Hmm.
Right? So if you're a corporation, you say, no, I'm going to pay this. I just got a big chunk of money. Leave that in the business. I'm going to pay to myself over 5 years.
Mhm.
You know?
Right. Yeah.
So it makes a big difference for the lender to be educated on, depending on how much they make, on what their entity is, whether an LLC or S corp or C corp, on how they're being paid.
Yeah.
Some people say, well, you only should be an S corporation. Well, they'll take a bigger salary, so they have a smaller distribution, so they don't need to be a C corporation. And then they have this thing they call this QBI, this business income deduction that happened in 2017 with Trump, and
Yeah.
this thing is going to expire in 2 years. But this thing made S corps the thing to be.
Mm.
What's going to happen in 2 years? QBI expires.
Yeah.
What's going to happen? Nobody's going to want to be an S corp in 2 years.
Yeah.
C corps are going to. Everybody's going to want to be a C corp in 2 years because QBI is going to expire. And when this happened, they brought the tax rate of the C corporations down from 37 to 21.
Mm-hmm.
So when the QBI goes away, the corporation tax rate stays. They didn't make the corporation tax rate temporary like they did the QBI. So QBI will go away, corporation tax rate stays, S corps go away, and everybody will become an SC corporation.
So
we're going to have fun converting everybody.
Right. I know a lot of persons, they just have because I've recently started realizing the benefit of having the C Corp, the S Corp, all those different things. But I know a lot of private money lenders, they only have a LLC. That's the only thing that they have. And a lot of times that LLC is a single member LLC.
Mm-hmm.
So when they get paid out a large amount, say that $100,000 within that tax year, are there some things that they can do creatively to offset that payment that they've made in let's say interest income for that entire year, especially because it's an LLC and they're a single member entity?
There are a lot of things they can do. If they have, also they're paying for their own health insurance, and if they're healthy people, especially if they're younger, if they're healthy,
Yeah.
and they get the insurance which has their the high deductible, they can invest in a health HSA. So they put money into the HSA, which means they have to have a high deductible health plan. And the HSA is amazing because the only thing they can put money in and take money out of tax-free. And they can put money into the IRA. But you know, you can also be doing some amazing retirement planning. Are some amazing things out there that are tax-free retirement if you put money into it.
Yeah.
It's okay to have some both pre-tax and post-tax retirement. You know, there are some pre-tax retirement plans out there. I know some who put anywhere from $100,000 to $200,000 into retirement plans every year. So if you make $100,000 on one deal, and you're doing multiple deals like that, you could easily maybe qualify to put $100,000 into some of these cash balance plans.
Yeah.
And if you could protect $100,000 just into one retirement plan, that'd be great.
Mm-hmm.
It'd be an amazing way to protect $100,000.
Would you? This just came to me while they're explaining these things. I don't know if it's even possible, but let's say you do that tax-free retirement account. It's their money, and they take that 100 within that same tax year, open that pre-retirement account. Can they also use that account and borrow from it and lend again?
I don't know if you can borrow from that or not. The thing about those some plans you can borrow from, some plans you cannot.
Okay.
Some plans you can put money into, and you can move. It's like if you put money into a traditional IRA, you can roll it over into a Roth.
Yeah.
Or you can put money into multiple and then roll them over into something. The cash balance plans, I'm not sure if you can roll them over to. That's something I could always look into. Okay. But these are really high dollar plans, so you may not be able to. These might just be where you have to just put the money in there, and it just, if you're putting $100,000 into it, it probably just exponentially goes up.
Okay.
You know, it may just be something you don't want to pull money out of, because it's going to exponentially go up. But if you're putting money into retirement plans, you want to start as soon as possible so that you can start building that as soon as possible. Because if you have kids, you can hire your minor children. You can pay them what is a fair market wage for the work they actually do, and we call that income shifting. Let's say you can pay them $500 a month for what they do because they're too young, you can't pay them a lot. Mm-hmm. Well, that money can go into an IRA, a Roth for the kids. You know, now you're going to pay them, and then over time that money will go for them. And not only that, but if you have 5 kids, and my friend has 9 kids, then that money will start to grow, and you can actually take their Roth, and their Roth can partner with your Roth. Mm-hmm. So you can pull money from their Roth. Let's say you have 9 kids, and all 9 kids, you put $500 every year. So in 10 years, that's $5,000, and you got 9 kids, and you got yours, and you just partner everybody together, and you all got money in it, and you got 10 persons with Roths, and you partner all of them together and buy something. Partner them all together. Wow. So you can do things like that. You can partner all the Roths together. You have to split them all up into different accounts. Do it. 529 plans. They used to be the child education plans. They used to be tax deductible. They're not anymore on federal. Some states do, but not them all. So I didn't used to be a fan of them.
Kathy, which plan is that?
The 529 college plans. You didn't used to be a fan of them because they're not tax deductible anymore. And if your kid doesn't go to college, they were kind of wasted. Then you paid tax on them. Yeah. Now, if they're not used, you can roll $35,000 over into a Roth. And that's even if the person never worked. Yeah. So now you can stick that money into a 5. There's another place you can stick money into for your kid. And if they don't go to college, you just roll that money into a Roth for them. So it's another place to stick some money. Unfortunately, it's only some states it's tax deductible, but still, it's a place to stick some money to roll into a Roth.
Yeah. Yeah.
And then once you get it roll it into a Roth, you can use it for investing. So it's another place to stick money to roll into a Roth.
Yeah.
So
Joseph
there's
has a
places to do
question.
things. You just have to know where they are.
Yeah.
It's true. So Joseph has a question. How much money can you put in a child Roth IRA this year? I don't know if you know the answer, Kathy.
Not more than the child. So the Roth, every Roth has a limit, and not more than the child earns. The child, even if the child earns less than the legal limit, you can't put more than the child earns.
Okay.
So if
So
we have to look up
question.
the limit.
Okay, so I know that in the Roth, they're like it's a yearly amount. The maximum annual contribution is what they call it.
Yes, it's $6,500 this year with $1,000 catch up. So
yes.
that's the same amount for child, but the child can't put in more than they actually earn.
Okay. That
Wait,
clears it up.
So I'm a little bit lost, Kathy. Could you just repeat that portion of it? Where
So you can put up to $6,500 a year into a Roth.
Mm-hmm.
If you're over 59 and a half, you can put 75 in.
Okay, that makes
But
sense.
the child, so let's say you only earn $5,000. You can't put more than $5,000 in.
Mm.
You can't put in more than you can't say I earned 5,000. My mom gave me 1,000. Now I have 6 to put in. You can't put in more than you earn.
Okay. That makes sense. That makes so much sense. You mentioned record keeping we should always do record keeping. Is there like any softwares that you prefer or any method or like a best way to do record keeping, or it doesn't matter?
So generally the biggest one that's in use is QuickBooks. It's also been the biggest headache. They have had constant price increases.
Mm-hmm.
Okay, you don't have to use QuickBooks.
Yeah.
Wave, W-A-V-E, Wave is free.
Yeah.
If you need free, use Wave.
Mm-hmm.
I like Xero, Xero. It's a little different. It doesn't have quite the same reconciliations, but it's okay.
Yeah.
And I like Accounting Suite. And Accounting Suite is way cheaper. I'm quite happy with Accounting Suite. Accounting Suite feels like a desktop software, but it's online. I really do like Accounting Suite. But the most popular is QuickBooks. They've had some problems, and they just constantly raise their prices. They're doing another price increase.
Yeah.
So if you need free, go to Wave and do it, and just
yeah, because Wave is way more user friendly. It captures the same thing as QuickBooks, and it's super simple. Because Wave was what I started using first before I went to QuickBooks, and then QuickBooks got so expensive. They did like a price increase last December, and then I think in April they did another increase. So it's like I totally get that what you're saying. It's like increase after increase, and it just doesn't make any sense.
Even the professionals who are using QuickBooks are using it because it's the most used one out there.
Yeah.
And I know even professionals are asking, what are the other options we can really change to?
Mm-hmm. No, you're so right. You're so right. Yeah, guys. Wave free, guys, and it's very user friendly. They also have like apps that you can keep it on your phone. You can still track your receipts. You can upload your receipts using Wave. You can create invoices from Wave, and everything you can do desktop, and you can also do it with the app as well. There was a question that was in my head, and I totally forgot, but I know we'll come back.
Yeah.
We'll come back. But do you have one?
I do actually. We've talked about like all the positive sides of like lending, but what happens? Like, how do you report if you actually lost? If you lent some money and they didn't perform for some reason, how does that look like on your taxes?
Oh, that's not good. Definitely would not show profit.
Yeah.
Yeah, so if you lend out money, obviously, and you don't get your money back, you're going to show that as a loss on your taxes. And, it's going to reduce your profit. We don't want to see a reduction. Definitely don't want to see a reduction in our profit that way. We want to see reduction in good ways. We don't want to see it that way. It's going to happen. I would say you can't really get in the business and say that's never ever going to happen to you. I think everybody's going to have a loss one way or another in some type of form. Everybody's going to get screwed over at least once, probably, and hopefully it's a small one. But you can take it as a loss against your income.
Okay, that makes sense. I actually just remember the question that I had. It was around where was it? It was in terms of, let's say that, what I put this so it makes sense. I know like lenders who, for example, one lender specifically is very strategic with how he does his interest income, how he structures it. And he kind of do it for tax purposes. Whereas let's say if he lends $100,000 and if he could get 15%, instead of him being paid the 15% in the 6 months, he would do, let's say, 9% for one tax year. And then that 9% will be paid to his LLC. And then he would do the remaining amount, like that paid to his personal social, like let's say a consulting fee. Have you ever seen something like that before done so creative?
No, but I think it's a waste.
Why is that?
Because an LLC is asset protection, and it is reported on your personal return. So if you know how a tax return is reported, an LLC is reported on your personal tax return on a Schedule C. And that second part, his consultancy, however he does it, is also reported on a Schedule C. So they're reported in the same place.
What if it's
so they're both reported in the same place?
What if it's a multi-member LLC?
Well, if he's filing a partnership return, then they're reporting it on a partnership tax return. They're each getting a K1.
Yeah.
However, it's being split, and then it's getting reported on his tax return. So then it doesn't matter either. Okay. So either way, it's ending up on one place, whether he's putting $10 plus 5 here or $10 plus 5 here. So it doesn't matter. It's all the numbers are going to the same place. So he's really not saving it.
Is there? I don't know if it's possible. But what if he brings over the remaining amount to the following tax year? Does that help?
That's fine, because then you're splitting income up into 2 years.
Okay.
So you could be in a different tax bracket then. So if you're paying enough attention to how much money you make.
Yeah.
And this is why, if you really pay attention to how much money, you keep good tax records. And you can Google a chart on the tax brackets. You can see how much money you make until you hit the next tax bracket. So if you said, okay, if I can make $300,000 and I'll stay in the 20% tax bracket, but if I make 301, everything I make over 300 is now taxed at 24%. So maybe I want to stay. I don't want to make anything over 300, so I don't make any more than that. Well, I'm going to make all my other income due that next year, so I can start back over in the 10% tax bracket. So that's one way to look at it, but you have to know how much money you're making. You don't know how much money you're making unless you're keeping good books.
So let's
You think it all ties back to how good your books are?
but let's say like it's July and I made that 300,000 and I know that I'm gonna go over. What if by like October when I like forecasted my income and I realized that my income is gonna go to about 600,000? What if I take 300,000 and reinvest? Will I still be taxed on the full 600 or will I be taxed on only the first 300?
If you actually received that 600,000 in hand, you'll be taxed on that 600,000.
That's why people keep money in escrow.
So you, if it's in escrow, you still received it. It's called constructive receipt because you have access to the money. You had access to the money. You could come into escrow and take it anytime you want. It's like a bank account. You had access to come and get it. It's good constructive receipt. But what you could have done is said, I'm not sure that I'm going to want to use this money yet this year. It's going to be due to me. Maybe you just want to tell the client to maybe save that as a balloon payment till next year, till January 1. Maybe you can rewrite the loan or something and have a balloon payment on January 1.
Isn't that risky? Because the money will be out and you don't want the lender, the borrower to like use the money.
Maybe if you don't want it, maybe you want to have that. You said maybe you want to rewrite it so it's a balloon payment on January 1. Instead of if it's in escrow, you have access to money. You just have to go get it.
But what if
you do not have access to it?
What if they send it to escrow, we close out on that loan, but immediately after I have another loan that I want to lend on?
You still have access to it. It's constructive receipt. You still have it. It's still your money at that time.
See?
Yeah. It doesn't matter how you use the money. You still have the money. Doesn't matter what you used it for. Yeah, it's an old argument. How could I have made any money? I don't have any in the bank.
Yeah.
And that's why people start putting.
If we got taxed by how much money we had in the bank at the end of the year, we wouldn't have any tax.
Yeah. And that's why people start putting money into retirement accounts, which I have seen people just start moving their funds there so that they can start investing from their retirement account.
Right.
See, that makes sense.
The more you can put into the retirement account, the better, because any money that you put into a retirement account, you invest from, all those funds are being earned tax-free. All that. I mean, if you're putting into a Roth, all the earnings are tax-free. All that money is tax-free. It's all tax-free. It's a fabulous way to earn money.
Yeah.
I mean, I'm investing in 12% funds in my Roth, and all that money grows tax-free.
Yeah.
Very true.
And so then it's like, I don't have to do. Somebody asked me, well, you have to do depreciation on that. No, I don't have to do depreciation. Don't have to do cost seg, nothing. Because why should I have to do it? I don't have to do any of that.
So no cost segregation.
No, because it's tax-free. You don't have to write anything off.
Now, Kathy, do you know anything about the tax-free bonds?
So there are different types of tax-free bonds. It depends on where you're buying them from. Some bonds are tax-free to federal only. Some bonds are tax-free to the state only. Some bonds are going to be tax-free to both federal and state. So it depends on where you get them, what types of bonds you buy.
Okay, but you're still getting taxed. Well, I heard you weren't getting taxed on the income that you get from those tax-free bonds.
Correct. It depends on which ones you buy. So if they're tax-free from federal, then you don't pay any taxes to federal on them. You might pay some tax to state. If they're tax-free to the state, then you pay federal tax on them. If they might, or they could be tax-free to both federal and state, then you pay no tax on them. And if they are tax-free bonds, they usually have a lower interest rate. So you have a trade-off, a lower interest rate for tax-free or a higher interest rate in pay tax.
Mm.
So you might get like a 3 or 4% interest rate on tax-free, where you might pay, or you might get a 10 or 12% interest rate on something that's taxed.
No.
So then the question is it worth it?
No. No.
And how do you know the difference from being federal, state, or both?
Depends on where you buy it. If you're buying something from, if you're buying something through a federal program, it's usually federally tax-free.
Mm.
So you'll know when you buy it where it's tax-free. Did you know that when you get your federal tax refund, you can use it to buy I-bonds?
You can use it
When you get your federal tax refund, instead of getting your whole refund, you can actually buy I-bonds with your tax refund. Most people don't know, and not all taxpayers ask.
Mm-hmm.
But if you want, you can use some or all of your federal tax refund to buy bonds. All right, at that time, when you haven't even seen or used the money yet, you wouldn't even really notice that you don't have it, because money you don't have, you wouldn't even really notice it's on. You could use it to buy bonds. But then, is it worth it to you? Is it high enough interest to make it worth it to you?
No,
Yeah.
Man,
Yeah.
can't be. This was like so good. Like I learned a lot. I mean, it's a lot of info at once, because as I said before, a lot of persons hate talking about the whole tax aspect of investing. They only want to talk about it when it's tax season. And sometimes it's too late. We've even heard multiple times that we should do tax planning throughout the year, meet with your tax person and just prep, especially if you're actively like doing business, you're actively fixing flipping, you're actively lending, like preparing stuff. You mentioned one pet peeve. So to wrap up, you mentioned one pet peeve and how to approach that. Is there anything else that you have seen that persons do right before tax season that it's like, you guys need to stop this now and do this instead to better benefit from the tax credits that's available?
So one thing that people want to do at the end of the year sometimes is to become an S corporation, because you're supposed to become an S corporation at a certain time of the year, but we actually can backdate it. The problem is, if we backdate it, you're not necessarily in compliance. So if you want us to backdate a corporation, then you have to be in compliance, which means you have to have taken a salary. So if you want to plan to you have to take a salary. And we can actually do, if you put the money aside with the intent of possibly becoming an S corporation at the end of the year, put the money aside in December, and we can do one big salary in December. We can do one big salary check in December. So that you're in compliance, at least for this. Even if it's not like a whole year's worth of salary, we can at least do one big paycheck. But in order to do that, we have to get, if you haven't had employees before, we have to get your EIN number with the federal and with the state, so we can do withholdings. These things, are not things that happen in 1 minute.
Yeah.
So we have to be able to plan and get these kind of things done. So it's much harder. So we can't do a paycheck in January. Have to be in compliance to do a backdated S corporation.
Yeah.
We can do it, but then you're not going to be necessarily in compliance. So it happens. So if that's something you're thinking you might want to do, put the money aside so that we can do a large paycheck in December. So at least you're somewhat in compliance to do one large paycheck. When I say a large paycheck, I'm talking at least like $20,000, $30,000.
Yeah.
It may not be a fair market wage for what you're doing, but at least we have a fair, good amount of money. And you have to be an LLC or a C Corp already.
Yeah.
And most people are anyway.
Okay.
So that's something that we can actually do to backdate to help you save a whole bunch of money, at least, usually.
That is good. Okay. Kathy, how, if someone wants to reach out to you, how can they contact you for tax planning for anything that was discussed today?
So I've actually just kind of recently changed my business name, but my old email is email is Kathy at, we have my business name there, so Kathy at Elite Tax Inc.
Okay.
It's Kathy, CATHI at EliteTaxInc.com.
Gotcha.
And
I
yeah,
think
my goal is how much money can we get out of your business? I'm the concierge real estate tax professional.
Love it.
So Kathy, something I wanted to ask before we say our goodbyes is, how would you or what would you say to people who, because I know you take certain clientele, someone who doesn't fit your clientele box, what would you tell them or advise them to look for into when they're looking for a tax expert?
I would recommend that when you interview, before you settle for somebody, interview somebody to see what their expertise is. Find out what it is that they do. There are people out there who work with just anybody, which is, it's okay. There's some people who don't specialize in anything. I can ask you a few questions. I might be able to refer you to somebody specifically. You can go onto some websites like the National Association of Enrolled Agents and look for people in your area, or look just for somebody who has a specialty, even if they're not in your area. Don't be afraid to work virtually and expand out of your area for an expert. That's the big thing, is look for an expert in your area if you can't find one. But interview before you just settle for somebody.
Yes, thank you, Kathy. You gave so many great tips. I know I took some. Thank you guys for staying on and being here with us the whole time, and just asking questions, and just being here with us and in community, and be able to get so much knowledge from you, Kathy. I know I need to digest everything and sit with it for a bit, because it was a lot, and some of the things I'm just like, wow, that's so interesting. I totally understood it, and some things I'm like, I need to rewatch it. So thank you. I really, really appreciate you and your time. So whether you're looking to finance your next project, launch, or expand a new business, we hope that this episode gave you insights, strategies, and tips so that you guys can raise capital and invest with purpose.
Bye, guys.